Hey everyone, today is Tuesday, March 4th. I'm recording this, well, not recording, it's 5:43 p.m. and we're live on YouTube and X. Today I wanted to come on and talk about a thesis that I've been developing relative to what is going on in the market. It's a very crazy time, and Trump is causing a lot of volatility, especially the tariffs and what's likely to happen with the economy and jobs and inflation and ultimately Bitcoin. So first of all, what's going on with tariffs? Tariffs, a lot of people have talked about the effect of tariffs. People are very, very confused about how these tariffs are supposed to impact the economy. So let's talk a little bit about that. At its core, tariffs are self-destruction tools, which hurt if you're doing it right, which will hurt your counterparty more than it hurts you. But it hurts you as well. And a lot of people think it doesn't just because they couldn't find where to look into the data in 2018. They think there's going to be no effect, no damage to the economy. There will be, and we have more than a century of economic research and data to prove that. But the effect might be distributed across different parts of the economy, so harder to find. However, this time tariffs are strong enough for us to actually and clearly see the results. If you look at the data, right after Trump was elected, so in November, then December, then January, and then February, we've had back-to-back increases in inflation readings. And then we've also had increases in consumer expectations of inflation. Then in the most recent ISM manufacturing report, we are observing that manufacturers also in a survey reporting that their import prices, the input prices, are rising. So we are definitely seeing an inflationary effect. But that's not all of it. We are also seeing a slight slowdown in jobs. Again, the ISM survey shows that hiring has slowed a bit. I've personally heard of several companies that are on hiring freeze, and there is uncertainty around the health of the job market as well. Okay, so why does this happen? When you impose tariffs on a counterparty, essentially what you're doing is you're taxing the imports, but by extension, you're taxing economic activity. When you do that, essentially you're reducing economic activity. And some people say, oh, we can make the other party pay for all of it, which is just fantasy. It always hurts you as well as the other party. But the ratio could be different. Again, if you're in a really good position, you may hurt the other party a lot more than you hurt yourself, so that at least you can reach an agreement. But very important to understand, this is a self-destruction tool that hurts your opponent as well. That's the kind of way I've been always explaining them. Now, let's see if I can show you some data about the extent of these tariffs. Okay. Yes. No. Apparently, I've only shared one screen. Okay. Yes. So basically, this is data I collected from official reports on imports and exports. If we look at the countries that the U.S. trades with and imports goods from, Mexico, China, Canada, based on 2024 data, would be the top three. And the next one is so small, that's about 1/3 of the other ones. That's Germany, Japan, Vietnam, South Korea, Taiwan, Ireland, India, and so on. But they are way smaller than the top three, which is obviously the reason they are being targeted now. On a map, you can see all three are about 400 billion and 500 billion for Mexico. And they are the top three partners to the US. The Eurozone, if you combine all together, you get to 700 billion. So they won't even equal the other two, the top two partners together. Now, relatively speaking, again, you can see here how number four is way smaller than the top three. So hence the focus. Now, looking at Canada, we are importing a lot of energy from them. Oil, $124 billion. And then the next category, the most important one, is vehicles. Why vehicles? Because a lot of the vehicles that were supposed to be sold in the US go to Canada, they get some work done, most likely get assembled, and then comes to the US. Essentially, companies figured that instead of assembling them in the US, they can assemble them in Canada with cheaper labor and lower costs. So the raw materials and components go to Canada, get assembled, come to the US. That's why a lot of vehicle imports are happening here. There's also some machinery and electrical components and so on. Then we can look at Mexico. From Mexico, it's mostly vehicles. And the biggest category, 136 billion, are vehicles. The same thing. Mexico is even cheaper. So many manufacturers try to do their operations in Mexico and then move the products back to the US. And even after the additional logistics cost, it ends up being cheaper. Then there's also some machinery and electric equipment and so on. But most important thing is vehicles. When you look at China, the game is a little bit different. You have a wider variety of things. Biggest category is, again, electric machinery, sound equipment, TV equipment, all kinds of electronics, and other machinery as well. Then you have pretty much everything. Toys, plastic, apparel, iron, steel, footwear, anything, just you name it. This is just a ton of stuff that comes from China. And Trump is imposing 20% on China, 25% Canada, 25% Mexico. And today we also heard that all three are retaliating. China with 10 to 15% tariffs on the US exports, Canada with 25%, Mexico with 25%, both of them on select products. And both countries, both sides are now engaged pretty strongly in this trade war. Now, for the reasons that I explained, trade war will cause a slowdown of the economy for both sides. However, the effect is obviously going to be a lot more severe for China, Mexico, and Canada. If you look at my other chart, which I need to figure out how to dynamically. I've updated some settings at the wrong time. All right, so let me share this again. If you look at my other, okay, now I know what to do. If you look at my screen here, I have pulled up some data to compare the relative sizes of imports and exports. Okay, so Canada is exporting $413 billion to the US, and the US does only $290 billion of exports to Canada. So U.S. has the upper hand here in terms of the ability to enforce its economic wishes. The situation for China is a lot worse. U.S. is buying a lot of stuff, 440 billion, and not importing a lot of stuff. Not exporting a lot of stuff to China, only 125 billion. Mexico is half and half. We are importing $500 billion worth of goods and exporting 250 billion to Mexico. And actually, by the way, some of the stuff that goes to Mexico is like it's still for automobiles, but they go back and forth. So something's done in the US, then goes to Mexico, then comes back to the US, like a crazy trip in and out to save on costs because of the lower labor cost. But it's also important to note that these other countries are way smaller than the US. US GDP is 27 trillion. China is, I think, 17. Mexico and Canada both are tiny, like 3 trillion maximum. So way smaller than the US, but they export a lot more than the US. So basically their dependence is massive on the US. So this is what Trump is capitalizing on, leveraging this huge imbalance that US does not depend on them. They depend a lot on the US. The smaller economy, much more exports to the US, so they are much more dependent. Now, this is causing, some people to think there would be no negative effect on the US because of this. But again, it will also create uncertainty and risk in US markets as well, which is why we're seeing the stock market fall so strongly. If you look at NASDAQ, S&P, Dow, you will see the extent of the panic, because finally investors are figuring out that the tariffs are, they have negative effects on both inflation and growth. So essentially you're getting stagflation. The odds of stagflation goes higher the longer we play with these tariffs, okay? And then, so the hope is that we implement these tariffs, and then that kind of brings the other countries to their knees, and they will give in to some sort of agreement to the US, which is always a possibility, and it's a very strong possibility. But in the meantime, we are also damaging our own economic activity. So, which brings me to my thesis about what's going on. First of all, everything that people have been, particularly the supporters of the administration, have been saying, oh, there's going to be no effect, nothing, just, enjoy your time and no inflation, nothing. We are hearing panic in corporate America. We are hearing a lot of front running of tariffs. They have been importing a ton of stuff ahead of time. So they are really, really scared, and they're really impacted. And just 10 or 20% tariff on that adds to their import costs will erode their profits by a pretty significant margin. And if you do the math, this is one of the earliest exercises we do for our students in class, is that 5% increase in the cost of raw material could end up hurting your profits, not by 5%, a lot more, maybe even 50%, 30%, because profit margin is just a very small chunk of your top line, and a damage to top line could completely erode your profits. So this is pretty significant, and the direct effect is bad, but what's even worse is the uncertainty. Like, no one knows what's going on, what's happening in future. Howard Lutnick just has hinted that the administration might give some relief to Canada and Mexico right after they scared the market to death today. So let's see, maybe tomorrow they'll reach a deal. But before that, until they reach that deal, the economy and the market will be in panic mode. Okay. which means crash. Investors would sell stocks, then go to bonds. If they feel even worse, they'll go to cash and gold. And money will also be exiting the United States, maybe going to other assets and so on, like international investors, but maybe cashing out or trimming their positions. Everyone knows when there's volatility, you have to be much more conservative. All right, so that's the first step. However, it's a very interesting dynamic, because that to some extent might be what the Treasury Secretary Scott Bessent actually wants, because they're trying to fight inflation for now. Okay, and if they damage the economy through a trade war enough, that will cause a significant slowdown. Plus, they're also reducing government spending, which will also slow down the economy. Both of them will have disinflationary effects. If that happens, then they will give up some GDP, but they'll gain inflation. They'll gain in deflation. Once they have dealt with inflation, they can claim victory, and bite inflation in their terminology will be defeated. Then there would be time to deal with lower growth. How do you deal with lower growth? Well, deregulation that they're planning to do, tax cuts, and because inflation has gone down, the Fed will be able to come in and stimulate the economy through further rate cuts and QE and purchasing bonds, all of which will lead to a massive stimulus to the financial assets and risk assets, including Bitcoin. So this is why I have this thesis that is basically we are in a V-shaped economy. We are going down the valley because that's what they initially want. And then once we get to the bottom of the valley, instead of panic selling, it's exactly the place where you want to accumulate as much as you can, because then they will come massive stimulus. So this is how I think about the market. This is a mental model I have, and we've already seen a massive reduction, especially crashes and corrections, especially in Bitcoin. Stock market is down a lot, but Bitcoin is down by some of the largest values that we would have expected, 30% or more. Which means Bitcoin might be ahead of other assets in getting close to the bottom. But we will see, even if we go a little bit lower, it will just, for me, be a sign that it's just a better place to build and expand the positions that I've had in mind. But if that's the game, any reduction and any crash will actually look like a fantastic opportunity. All right. So those are my thoughts. Hopefully that helped. Talk to you next time.